Welcome to Fall Asleep Smarter, where your mind rests but keeps learning. Tonight, wisdom and skepticism from a man who spent a century learning how to think. Relax and let your subconscious grow richer. There's something haunting about a warning delivered in the final act. November 28, 2023. A hospital room in Santa Barbara, California. Charlie Munger, 99 years old, mentally sharp until his last conscious hours, just 34 days shy of his 100th birthday, left this world quietly, peacefully, without fanfare. But he didn't leave silently. Throughout his final year, the world erupted in celebration over artificial intelligence. ChatGPT became the fastest-growing application in history. Trillion-dollar valuations materialized around companies that had never turned a profit. Investors proclaimed a new era that would change everything forever. Charlie Munger offered a different perspective. Something simple, something most people dismissed. "I think it's getting a huge amount of hype," he told an audience at the Zoomtopia conference in October. "And I think it's probably getting more than it deserves." At Berkshire Hathaway's annual meeting in May, his message was clear. "I am personally skeptical of some of the hype that has gone into artificial intelligence. I think old-fashioned intelligence works pretty well." The audience applauded, then went right back to buying AI stocks, because during manias, cautionary voices sound quaint, outdated. The skeptics get dismissed as people who don't understand the revolution. But Munger had witnessed revolutions before: the dot-com bubble, the housing crisis, speculative frenzies that destroyed fortunes while minting others. Through it all, he'd cultivated something rare: the ability to recognize patterns of human behavior that repeat across generations, wearing different costumes but following the same script. So when he detected echoes of crazy hype in AI, when he noted that it is not going to cure cancer, what exactly did he see that everyone else was missing? Why did one of the greatest investing minds spend his final months cautioning against the technology the world was racing to embrace? Tonight, we'll explore Charlie Munger's parting message. We'll trace the philosophy he built over nearly a century. We'll examine the psychological patterns that cause intelligent people to make catastrophic mistakes. We'll look at what he understood about bubbles, human nature, and the gap between technological promise and investment reality. Was his skepticism the wisdom of a sage who'd seen this before, or simply caution from someone who'd lived too long in a different era? So find your comfort, release today's weight, and if you'd like, drop a comment letting us know where you're joining us from tonight. These stories take shape through the community that gathers around them. Now, let's begin. The legend who spoke in silence to understand Charlie Munger's counsel about AI. You first need to understand who he was. Not just his accomplishments or his wealth, but the way his mind operated, the philosophy that guided him, the principles he spent a lifetime refining. Charles Thomas Munger was born on January 1st, 1924, in Omaha, Nebraska. As a teenager, he worked at Buffett & Son, a grocery store owned by Warren Buffett's grandfather, Ernest Buffett. Even then, before either man knew what they would become, their paths were quietly intersecting, laying groundwork for a partnership that would reshape American capitalism. Munger studied mathematics at the University of Michigan, but left to serve in the U.S. Army Air Corps during World War II. After the war, using the GI Bill, He attended Harvard Law School despite never completing his undergraduate degree. He graduated and practiced real estate law throughout the 1950s, building a comfortable but unremarkable career. But something wasn't satisfied. Law was fine. It paid well. Yet Munger's mind was restless, curious, always seeking better ways to approach problems. In the 1960s, he shifted his focus to investments, forming his own partnership, Wheeler, Munger and Company, and beginning the journey that would eventually bring him to Warren Buffett. Their partnership formalized in the mid-1970s when Munger became vice chairman of Berkshire Hathaway. It was built on something unusual: complementary ways of thinking. Buffett brought discipline, focus, and an encyclopedic knowledge of businesses and markets. Munger brought what he called worldly wisdom, a multidisciplinary approach to understanding reality that drew from psychology, mathematics, physics, biology, history, and philosophy. "Charlie and I think pretty much alike," Buffett wrote to shareholders. But that similarity was built on Munger's influence. It was Munger who steered Buffett away from buying mediocre companies at great prices toward acquiring wonderful companies at fair prices. It was Munger who emphasized the importance of understanding competitive moats, management quality, and long-term compounding. It was Munger who introduced the psychological dimension to their investing, helping them sidestep the behavioral traps that destroy most investors. And throughout his career, Munger became known for one particular talent: the ability to say no. While others chased the hot investment, the trending stock, the revolutionary technology, Munger remained still. He waited, he considered, and more often than not, he declined to participate. "I'm no genius," he once said. "I'm smart in spots, but I stay around those spots." This notion of staying within his circle of competence, of refusing to invest in things he didn't understand, became central to his philosophy. And it demanded something difficult: the willingness to watch other people accumulate wealth while you remain on the sidelines. During the dot-com bubble of the late 1990s, Berkshire Hathaway was pilloried for missing the technology boom. Investors mocked Buffett and Munger as dinosaurs who didn't grasp the new economy. The stock languished while tech shares soared to absurd heights. And what did Munger do? He sat quietly. He read. He considered. And he refused to participate in something he viewed as madness. When the bubble burst, when trillions of dollars evaporated, when companies with billion-dollar valuations collapsed to zero, Munger's wisdom became obvious. But that vindication came years later. During the mania itself, saying no demanded extraordinary discipline. This was the man who, in his final year, examined artificial intelligence and detected echoes of that same mania. By 2023, Munger was 99 years old. Many people at that age have lost their mental sharpness, not Munger. His family reported that even at Thanksgiving dinner, just days before his death, he was engaging, humorous, full of wit, sharp as ever. His final interviews reveal a man completely in possession of his faculties, clear, direct, uncompromising in his assessments, and when asked about AI, he didn't hedge. He didn't try to sound optimistic or forward-thinking. He simply stated what he believed, that the hype exceeded the reality, that traditional intelligence remained valuable, that people were getting carried away with promises that might never materialize. He died on November 28, 2023, just weeks before what would have been his 100th birthday. The timing carries a certain symbolism, as if he'd witnessed enough, as if he'd seen the AI mania reach levels that confirmed his suspicions, and his work was complete. The outpouring of tributes was extraordinary. Warren Buffett said Berkshire Hathaway could not have been built without Munger's inspiration, wisdom, and participation. Apple CEO Tim Cook called him a titan of business and keen observer of the world. Investors around the globe mourned the loss of a man whose wisdom transcended mere financial success. But perhaps the most meaningful tribute came from those who never met him. The readers of Poor Charlie's Almanac, the listeners who'd absorbed his talks on the psychology of human misjudgment, the investors who'd internalized his mental models and used them to navigate complexity. Because Munger's greatest legacy wasn't the billions he accumulated. It was the thinking tools he shared, the frameworks he built, the wisdom he distilled from a century of observation and reflection. And one of his final acts was to caution us about the very technology that the world had decided was unstoppable: the AI hype machine. To appreciate Munger's skepticism, you need to understand what he was skeptical of, what the world looked like in 2023, the atmosphere, the frenzy, the absolute certainty that AI was about to change everything. ChatGPT launched in November 2022. Within 2 months, it reached 100 million users, becoming the fastest-growing application in history. Suddenly, everyone was experimenting with AI, writing with it, creating with it, imagining futures where AI handled everything from customer service to medical diagnosis to creative work. The stock market responded accordingly. Nvidia, the company making the chips that power AI systems, saw its value skyrocket. Microsoft, which had invested heavily in OpenAI, surged. Companies with even the slightest connection to AI saw their valuations multiply. By May 2023, when Berkshire Hathaway held its annual shareholder meeting, AI had become the dominant narrative in markets. Earnings calls mentioned AI more than 1,000 times in the first quarter alone, more than double the previous year. Everyone wanted to be part of the story. And into this atmosphere of unbridled enthusiasm, Charlie Munger spoke words of caution. At the shareholder meeting, someone asked about AI's impact on the stock market and society. Munger's response was characteristically direct. "I am personally skeptical of some of the hype that has gone into artificial intelligence. I think old-fashioned intelligence works pretty well." The audience applauded. But it's worth noting, they applauded, then went right back to investing in AI stocks, because that's what happens during manias. Warnings sound reasonable in the abstract, but they don't transform behavior. The momentum is too strong, the fear of missing out too intense, the examples of people getting rich too vivid. Warren Buffett, sitting beside Munger, added his own concerns. He'd tried ChatGPT, shown to him by his friend Bill Gates. He acknowledged it could do remarkable things, but he worried about consequences, about what happens when you unleash technology that can't be uninvented. Buffett compared AI to the atomic bomb, invented for good reasons during World War II, but carrying implications for the next 200 years that remain unclear. "When something can do all kinds of things," Buffett said, "I get a little bit worried because I know we won't be able to uninvent it." But Munger's skepticism went deeper than concerns about misuse. He was skeptical of the fundamental premise that AI represented something entirely new. We've always had artificial intelligence, where software creates more software, he explained at the Zoomtopia conference. And of course, that's very useful, but we've had it for a long time. His point was subtle, but important. AI wasn't brand new. Machine learning had existed for decades. Software automation had been improving for generations. What was new was the interface, the accessibility, the promotional noise. But the underlying concepts, those had been around. And when Munger looked at past technological revolutions, he saw a pattern. The technology often proved transformational, but the investments made at peak hype almost always proved disastrous. He told CNBC in February 2023. There's a lot of crazy hype on the subject. Artificial intelligence is not going to cure cancer. That line, AI is not going to cure cancer, revealed something crucial about his thinking. He wasn't saying AI wouldn't be useful. He was saying it wouldn't deliver on the utopian promises being made, that the gap between hype and reality was enormous, that investors were pricing in miracles. And he'd seen this before. During the dot-com bubble, investors were told the internet would revolutionize everything. And you know what? It did. The internet transformed commerce, communication, media, entertainment, nearly every aspect of modern life. The promise was real, but that didn't make internet stocks good investments at those prices. Companies with no path to profitability were valued in the billions. Pets.com, Webvan, hundreds of others, they all crashed and burned despite the internet revolution actually happening. Munger recognized the pattern repeating. A genuine technological advance, enormous possibilities, and investors so excited by the future that they paid any price, assumed any valuation was justified, believed that normal rules didn't apply. I think old-fashioned intelligence works pretty well, he repeated. And embedded in that simple statement was a lifetime of wisdom about how to think clearly when everyone around you has lost their minds. Because old-fashioned intelligence involves asking basic questions, like, how will this company make money? What are the actual use cases? Is the current price justified by credible future earnings? Can the technology deliver what's being promised? These weren't exciting questions. They weren't visionary, but they were the questions that separate genuine investment opportunities from speculative frenzies. And in 2023, almost nobody was asking them. Munger's philosophy of avoiding stupidity. Charlie Munger didn't build his fortune by being smarter than everyone else. He built it by avoiding stupidity. And there's a profound difference between those two approaches. Most people try to be smart. They seek brilliant insights, clever trades, sophisticated strategies. They want to be the person who spots the next Amazon, the next Apple, the next revolutionary company before anyone else. Munger took the opposite approach. He focused on not being dumb, on avoiding the mistakes that destroy wealth, on recognizing patterns of foolishness and staying away from them. It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, he once said, instead of trying to be very intelligent. This philosophy came from a mathematical insight he learned early in his life. In algebra, there's a powerful problem-solving technique, inversion. If you're trying to solve a difficult problem, sometimes the best approach is to invert it. Turn it upside down. Instead of asking, how do I succeed? Ask, how would I fail? Then avoid those failure modes. Munger applied this relentlessly. Instead of seeking brilliant investments, he catalogued stupid mistakes and avoided them. Instead of trying to predict the future, he identified situations where the risk of ruin was high and stayed away. Instead of following the crowd, he studied crowd psychology to understand when collective behavior was likely to be wrong. This led him to one of his most important insights: the psychology of human misjudgment. In 1995, Munger gave a speech at Harvard that would become legendary in investing circles. It was called The Psychology of Human Misjudgment, and it outlined patterns of irrationality that cause intelligent people to make catastrophic errors. The speech was heavily influenced by psychologist Robert Cialdini's book Influence, though Munger expanded and refined these ideas through his own decades of observation. But Munger went further, combining insights from psychology, economics, biology, and his own decades of observation to create what he called a latticework of mental models. These mental models were thinking tools, frameworks for understanding reality that came from different disciplines. And Munger believed that to think clearly, you needed models from multiple fields, not just your own specialty. In my whole life, I have known no wise people who didn't read all the time. None. Zero, he said. And he didn't mean reading just about investing. He meant reading widely, across disciplines, building a multidimensional understanding of how the world works. One of the most powerful models in his lattice work was the circle of competence. The idea is simple. Everyone has areas where they truly understand the subject matter and areas where they don't. The key to avoiding mistakes is knowing the difference, staying inside your circle of competence, refusing to invest in things you don't genuinely understand, no matter how attractive they seem. I'm no genius, Munger said. I'm smart in spots, but I stay around those spots. This sounds easy, but it's extraordinarily difficult in practice, because staying in your circle means watching other people get rich in areas you don't understand. It means sitting out entire industries. It means admitting ignorance when everyone else claims expertise. During the dot-com bubble, Munger and Buffett were mocked for staying out of technology stocks. They freely admitted they didn't understand the business models. They couldn't figure out competitive moats. They couldn't predict which companies would win, so they didn't invest. Critics said they were stuck in the past, that they didn't understand the new economy, that they were missing the opportunity of a lifetime. Munger's response was characteristically blunt. We don't have to be smart in every area. We just have to avoid being stupid. And when the bubble burst, when the supposed new economy collapsed, Munger's wisdom became obvious. But during the mania, it demanded enormous discipline to sit still while others were making fortunes. Another key principle in Munger's philosophy was understanding incentives. Never, ever think about something else when you should be thinking about the power of incentives, he warned. Because people respond to incentives in ways that are often predictable and sometimes perverse. If executives are compensated based on short-term stock prices, they'll optimize for short-term stock prices, even if it harms the company long-term. If salespeople are paid on commission, they'll sell regardless of whether the product is right for the customer. If analysts are rewarded for optimistic forecasts, they'll be optimistic. Understanding this helped Munger avoid entire categories of investment. Companies with misaligned incentives, industries where the structure encouraged destructive behavior, situations where the incentive system made bad outcomes likely. And when he looked at AI in 2023, the incentive patterns likely troubled him. CEOs promising transformation because their stock prices depended on it. Venture capitalists funding anything with AI in the name because exits were easy. Analysts projecting enormous growth because pessimism wouldn't get them invited to conferences. The incentives all pointed toward hype, toward exaggeration, toward claiming revolution, even if the reality was evolution. Munger also emphasized the importance of patience, of waiting for the right opportunity rather than forcing action. The big money is not in the buying or selling, he said, but in the waiting. This patience came from understanding that opportunities are not evenly distributed through time. Sometimes markets offer genuine bargains. Sometimes they don't. And forcing yourself to invest when there are no good opportunities is one of the surest ways to lose money. Berkshire Hathaway has, at times, held enormous cash positions. Waiting, watching, preparing for the moment when fear drives prices down to levels where the risk-reward equation becomes attractive. Most investors can't do this. Their clients demand action. Their psychology demands participation. The fear of missing out overwhelms the discipline of patience. But Munger cultivated that discipline over decades, and in his final year, watching AI stocks soar to absurd valuations, he simply waited, watched, and cautioned those who would listen that this wasn't the time to be aggressive. Echoes of past manias. Charlie Munger had seen this movie before, multiple times, across different technologies, different eras, different supposed revolutions that were going to change everything forever. And he'd learned that while the costumes change, the story remains the same. The tulip mania of 1637 in Holland, the South Sea bubble of 1720 in England, the railroad mania of the 1840s, the dot-com bubble of the late 1990s, the housing bubble of the mid-2000s. Each time, a genuine innovation or opportunity sparked initial interest. Then, speculation took over. Prices detached from fundamentals. Crowds convinced themselves that old rules no longer applied, and fortunes were destroyed when reality inevitably reasserted itself. Munger understood the pattern because he'd lived through enough cycles to recognize it. He'd seen how human psychology, particularly during manias, follows predictable patterns that lead to disaster. The dot-com bubble was particularly relevant to understanding his skepticism about AI because the parallels are striking. In the late 1990s, the internet was going to change everything. E-commerce would revolutionize retail. Digital communication would transform how people connected. Information would be democratized. The possibilities seemed endless, and all of that came true. The internet did revolutionize retail. Communication was transformed. Information became accessible in ways previous generations couldn't have imagined. But the companies that investors bet on, most of them failed. The valuations proved absurd. The business models didn't work. And billions of dollars evaporated as investors learned that technological revolution doesn't automatically translate into investment returns. During the peak of the mania, Berkshire Hathaway was criticized relentlessly. The stock underperformed dramatically. Investors pulled money out. Critics said Buffett and Munger were finished, that they didn't understand the new economy, that their value investing approach was obsolete. Munger's response was to do nothing, to sit quietly, to read, to consider, and to refuse to invest in businesses he didn't understand at prices that made no sense. "Warren and I are very good at changing our minds," he said, "but we're also good at not changing our minds when we don't need to." They didn't need to during the dot-com bubble. Their principles remained sound. The fact that others were getting rich on speculation didn't make speculation wise. When asked about missing the technology boom, Munger was characteristically blunt. "I think we're demonstrating the power of avoiding idiocy rather than the power of superior intellect." The companies Berkshire owned, insurance companies, furniture retailers, jewelry stores, newspapers, seemed hopelessly old-fashioned compared to the sexy tech startups that were being valued in the billions. But those old-fashioned businesses generated actual cash flows. They had proven models. They survived the crash. And when the bubble burst in 2000 and 2001, Berkshire emerged unscathed while trillions of dollars in market value disappeared. The Nasdaq fell 78% from peak to trough. Companies that had been worth billions went bankrupt. Investors who'd mortgaged houses to buy tech stocks lost everything. The supposed revolution was real, but the valuations had priced in a future that couldn't possibly materialize. Munger drew clear lessons from this experience. Lessons that shaped how he thought about AI 2 decades later. First lesson: technology can be transformational without tech stocks being good investments. The internet changed the world, but most internet stocks were terrible investments at 1999 prices. Second lesson: during manias, the crowd's certainty is inversely proportional to the wisdom of their actions. The more convinced everyone is that something is different this time, the more likely they're repeating ancient patterns of folly. Third lesson: being right too early is indistinguishable from being wrong. Munger and Buffett were right about the dot-com bubble, but they suffered through years of underperformance while being proven right. The market can stay irrational longer than you can stay solvent. Fourth lesson: the best investments often come after the mania ends. When fear replaces greed, when prices crash, when everyone else is selling, that's when genuine opportunities appear. These lessons weren't just abstract theory for Munger. They were earned through experience, through watching friends lose fortunes, through maintaining discipline when it felt like the world had left him behind, through being proven right years later when vindication offered no financial benefit but confirmed the wisdom of patience. And when he looked at AI in 2023, the patterns he observed likely seemed familiar. Valuations that required perfect execution for decades. Business models that assumed winner-take-all dynamics without evidence. Investors convinced that this time really was different because AI was smarter than previous technologies. But Munger knew that superior technology doesn't create superior investments at any price. That crowds are just as capable of delusion today as they were in 1637. That the fundamentals of value investing, buying assets for less than their worth, with a margin of safety based on credible future cash flows, don't change just because the technology is impressive. The technology might be revolutionary, his thinking suggested, but that doesn't mean the stocks are a good buy right now. The psychology of the AI bubble. Charlie Munger's speech on the psychology of human misjudgment provided a framework for understanding exactly what was happening with AI. The same cognitive biases that destroy wealth during every bubble were on full display. Start with social proof. Humans are wired to look at what others are doing and assume it must be correct. If everyone is buying AI stocks, the unconscious reasoning goes, they must know something. Surely all those smart investors wouldn't be wrong. But social proof is most powerful and most dangerous during manias. Because everyone is looking at everyone else, creating a circular reinforcement where nobody is actually thinking independently. They're all responding to each other's behavior, creating a feedback loop that drives prices to absurd levels. Munger saw this clearly in 2023. CEOs were mentioning AI in earnings calls because other CEOs were. Investors were buying AI stocks because other investors were. Analysts were projecting enormous growth because other analysts were. Nobody wanted to be the one left out. Then there's commitment and consistency tendency. Once humans make a decision, particularly a public one, they become invested in being consistent with that decision. Changing your mind feels like admitting you were wrong, which most people hate. So investors who bought AI stocks early became psychologically committed to that position. They sought out information that confirmed they were right. They dismissed warning signs. They couldn't objectively evaluate whether the investment still made sense because their ego was attached to being right. Munger understood this trap intimately. Whenever you think you've found something where it just seems too good to be true, he cautioned, that's when you should think most carefully. But during manias, people do the opposite. They turn off critical thinking. They embrace narratives that justify the prices. They convince themselves this time is different. Another powerful tendency at work was what Munger called deprival superreaction syndrome, his term for how humans react to the threat of missing out or losing something. The fear of missing the AI revolution created enormous psychological pressure. Investors didn't want to be the person who sat out the next Amazon or Google. They didn't want to explain to clients why their returns lagged while AI stocks soared. They didn't want to feel left behind. This fear overwhelmed rational analysis. It made people willing to pay prices they knew were unreasonable because being wrong was less painful than missing out. Munger had a simple observation about this. It is not given to human beings to have such talent that they can just know everything about everything all the time. But it is given to human beings who work hard at it, who look and sift the world for a mispriced bet that they can occasionally find one. The key word is occasionally, not constantly, not in every hot sector, occasionally. But deprival superreaction made investors feel like they had to participate in AI or suffer permanent disadvantage. And that feeling led to terrible decisions. There was also availability bias at work. AI was everywhere in the news. Every day brought new announcements, new capabilities, new promises. This constant visibility made AI seem more important, more certain, more transformational than perhaps it was. Munger noted that the human brain overweighs information that's readily available and vivid. A dramatic news story about AI creating art has more psychological impact than a boring spreadsheet showing that most AI implementations deliver minimal value. So investors were bombarded with vivid examples of AI's possibilities while being starved of sober analysis of its limitations. The availability of exciting information drowned out contrary evidence. Then, there was the Lollapalooza effect, Munger's term for when multiple psychological tendencies combine to produce extreme outcomes. In the AI bubble, social proof, commitment tendency, deprival superreaction, availability bias, and several other tendencies were all working in the same direction simultaneously. The result was an explosive combination that drove prices far beyond what any single tendency could achieve. Munger emphasized that understanding these tendencies individually wasn't enough. You had to recognize when they were combining, compounding, creating situations where rationality was almost impossible. And perhaps most importantly, there was incentive-caused bias. The people promoting AI, CEOs, venture capitalists, analysts, media companies, all had powerful incentives to hype the technology. Their compensation, their careers, their status all benefited from the narrative that AI was transformational and that early investors would be rewarded. Munger was fond of saying, "Never, ever think about something else when you should be thinking about the power of incentives." In the AI boom, the incentives were all aligned toward exaggeration, toward promising revolution, toward projecting impossible growth rates, toward ignoring risks and uncertainties. A CEO who said AI might provide modest productivity improvements over the next decade wouldn't see their stock price soar. An analyst who projected reasonable returns wouldn't get invited to conferences. A venture capitalist who expressed skepticism wouldn't get deal flow. So everyone had incentives to be optimistic, to hype, to promise more than they could deliver. Munger had seen this before. During the dot-com bubble, during the housing bubble, during every mania throughout history. And he knew that when incentives align toward collective delusion, the results are predictable. Understanding these psychological tendencies didn't make Munger immune to them. He acknowledged creating his own share of human misjudgment throughout his life. But it gave him a framework for recognizing when he and others were most at risk of foolishness. And when he looked at AI in 2023, every tendency was flashing red. What Munger saw that others didn't. Charlie Munger's skepticism about AI wasn't based on ignorance of the technology. It was based on deep understanding of how bubbles work, how valuations are justified, and how the gap between promise and reality destroys wealth. Based on his public statements and his lifetime of pattern recognition, we can infer he saw several specific problems that most investors were ignoring. First, the circular financing mechanism creating the appearance of revenue without genuine value creation. Consider the pattern. Companies like Nvidia invest in OpenAI, which then commits to massive spending, with Oracle and Microsoft, which then order billions in Nvidia chips. Money flowing in a circle, everyone reporting growth. But how much real, external demand is being created? This wasn't necessarily fraudulent, but it created the appearance of a booming ecosystem when the reality might be much more modest. The spending was real, but it was being funded by investment capital and debt, not by profitable business operations. Munger had seen similar dynamics before. During the railroad mania of the 1840s, companies issued bonds to build railroads that created demand for steel and lumber and labor. Everyone looked prosperous, until the railroads couldn't generate sufficient revenue to service their debts, and the entire structure collapsed. The question Munger would have asked is, when does this circular flow become self-sustaining based on genuine external demand? And what happens if it doesn't? Second, valuations that priced in perfect futures. OpenAI valued at $500 billion, despite never turning a profit. Nvidia trading at over 40 times sales at various points in 2024. Companies with minimal revenue achieving billion-dollar valuations simply by adding AI to their name. Munger's approach to valuation was grounded in fundamentals. A business is worth the discounted value of its future cash flows. If you can't credibly project those cash flows, or if the current price requires miracles to be justified, you don't invest. By that standard, AI valuations in 2023 were pricing in decades of perfect execution. No competition, no technological disruption, no regulation, no customer pushback, everything going exactly according to plan. In my whole life, Munger once said, I've never seen a plan work perfectly. Third, the gap between spending and credible returns. Companies were projecting spending of hundreds of billions on AI infrastructure. To justify that level of capital expenditure, AI would need to generate returns sufficient to pay back the investment plus acceptable profit. Munger understood that capital expenditure creates an obligation. If you spend billions building infrastructure, that infrastructure needs to generate returns sufficient to justify the investment. If it doesn't, you've destroyed value, not created it. And while AI might eventually generate those returns, the timeline matters enormously. If it takes 2 decades instead of 5 years, the returns become much less attractive. If it never happens, the invested capital is simply lost. Fourth, the nature of AI itself. Munger made an interesting point that got overlooked. We've always had artificial intelligence where software creates more software, he said. We've had it for a long time. He was noting that AI wasn't as novel as people claimed. Automation had been improving for decades. Machine learning had been developing since the 1950s. What changed was the interface and the accessibility, not the fundamental concept. This suggested that AI might be evolutionary rather than revolutionary. A continuation of trends that had been happening anyway, not a sudden breakthrough that changed everything. And if that's true, then the appropriate valuation is much lower than what markets were assigning. Fifth, the question of where value actually accrues. The companies promoting AI most aggressively weren't necessarily the ones best positioned to profit from it. If AI primarily benefits customers through lower costs and better service, who captures that value as profit? If competition drives prices down, how do AI companies maintain margins? These weren't questions people wanted to ask in 2023. But they were the questions that would determine actual returns. Sixth, and perhaps most importantly, the atomic bomb comparison that Warren Buffett made. Buffett noted that AI, like the atomic bomb, might be something we can't uninvent. And once it exists, the consequences might be unpredictable and potentially harmful. Munger, hearing this comparison, would have understood the implication. The atomic bomb was necessary during World War II, but its existence created risks that persist to this day. Nuclear proliferation, the constant threat of catastrophic war, AI might be similar, useful in specific applications, potentially beneficial in narrow domains, but carrying risks and consequences that we don't fully understand and can't fully control. And if that's true, then the question isn't just whether AI is profitable. It's whether AI creates externalities, costs imposed on society that aren't captured in company valuations. Munger's assessment, based on his public statements, seemed to be, AI is getting more hype than it deserves. It's not going to deliver the miracles being promised. Old-fashioned intelligence, human judgment, careful thinking, these remain valuable and perhaps irreplaceable. And for investors, the implication was clear. Stay away from the hype. Wait for reality to catch up to expectations. Don't pay today's prices for tomorrow's promises. The wisdom of not participating. One of Charlie Munger's most underappreciated talents was knowing when to do nothing, when to sit still, when to let opportunities pass by without feeling compelled to act. This is extraordinarily difficult for most investors. Doing nothing feels like failure. It feels like you're missing out. It requires watching other people get rich while you sit on the sidelines, second-guessing your decision. But Munger understood that sometimes the best move is no move at all. The big money is not in the buying or selling, he said, but in the waiting. Throughout his final year, as AI stocks soared, Berkshire Hathaway's portfolio reflected Munger's philosophy. The company owned boring businesses, insurance companies, railroads, utilities, consumer brands, companies that generated cash flows, that had proven business models, that didn't depend on revolutionary technology to justify their valuations. Apple was Berkshire's largest holding, but even that stake was being reduced substantially by Buffett throughout 2024 and into 2025. Not because Apple was failing, but because the valuation had reached levels that no longer offered adequate margin of safety. Berkshire wasn't buying AI stocks, wasn't investing in startups promising transformation, wasn't participating in the excitement, and this required enormous discipline, because every day brought news of AI companies raising billions at absurd valuations. Every week, someone Munger knew was probably making a fortune on AI investments. Every month, the question was probably asked, "Are you missing the next revolution?" But Munger had developed what he called sit-on-your-ass investing, the ability to wait, to do nothing when there are no good opportunities, to resist the psychological pressure to act. The wise ones bet heavily when the world offers them that opportunity, he said. They bet big when they have the odds, and the rest of the time, they don't. It's just that simple. In 2023, from Munger's perspective, the odds weren't favorable. The prices weren't attractive. The risk-reward equation didn't justify action. So Berkshire sat on a cash pile that would grow to exceed $380 billion. Waiting. Watching. Earning 4 to 5% interest on Treasury securities while inflation moderated. Not exciting, but not risky either. Critics asked why Berkshire wasn't deploying that cash, why it was missing the AI boom, why it seemed frozen while markets soared. Munger's answer would have been simple. We don't have to participate in everything. We only need to participate in things we understand at prices that make sense when the odds are in our favor. And AI in 2023 didn't meet those criteria. There's profound wisdom in this approach, because missing out on gains, while painful psychologically, doesn't destroy capital, but participating in bubbles can lead to permanent loss. Munger understood the asymmetry. If he was wrong about AI, if it turned out to be as revolutionary as promoters claimed, Berkshire would underperform. They'd miss gains. That's unpleasant, but not fatal. But if he was right, if AI proved to be overhyped and overvalued, avoiding it would preserve capital for deployment when better opportunities emerged. And that's how you build lasting wealth. The patience to wait for your pitch, as Munger liked to say, using baseball metaphor. In investing, unlike baseball, there are no called strikes. You can watch 100 pitches go by and nobody calls you out. The game waits for you to find your pitch. Most investors can't do this. The psychological pressure is too intense, the fear of missing out too strong, the need to justify their existence through activity too compelling. But Munger had cultivated this discipline over 70 years. And in his final year, with AI mania reaching fever pitch, he demonstrated it one last time. He sat still. He watched. He cautioned those who would listen, and he refused to participate in something that looked to him like every other bubble he'd witnessed in his long life. Final warnings and timeless lessons. In the months before his death, Charlie Munger gave several interviews and made public statements that, in retrospect, read like a farewell message. Not sentimental or nostalgic, but characteristically practical. Final wisdom from someone who'd spent a century learning how to think. His final interview with CNBC, conducted just 2 weeks before his death, showed a man completely at peace. He spoke about the progress of civilization, about the importance of avoiding standard ways of failing, about gratitude for a long life well lived. And when asked about his success, he credited caution, the ability to avoid mistakes, the discipline to stay within his circle of competence. "I've been very fortunate," he said, "but I think a big part of it is I've been good at avoiding all standard ways of failing." That phrase, all standard ways of failing, captures his entire philosophy. There are patterns to failure, predictable mistakes that destroy wealth across generations, and success comes not from brilliance, but from avoiding those patterns. Investing in bubbles is a standard way of failing. Paying premium prices for speculative promises, assuming this time is different, following the crowd into mania. And AI in 2023 had all the hallmarks. Looking back at Munger's framework for understanding human misjudgment, we can see how almost all of the cognitive biases he identified were on display in the AI bubble. Incentive-caused bias. People hyping AI because their compensation depended on it. Social proof. Everyone buying because everyone else was buying. Commitment tendency. Maintaining positions to avoid admitting mistakes. Deprival. Superreaction. Fear of missing out. Overwhelming rational analysis. Availability bias. Vivid examples drowning out statistical reality. Authority misinfluence. Trusting expert predictions without independent thought, and the Lollapalooza effect, all of these combining to produce extreme irrationality. Munger had mapped the territory of human folly so thoroughly that watching AI unfold must have felt like watching a familiar play with new actors. And his counsel was simple. Don't be part of the audience when the theater collapses. But there's something deeper in Munger's final message about AI, something beyond mere investment advice. I think old-fashioned intelligence works pretty well. That statement wasn't just about AI versus human intelligence. It was about values, about what matters, about the difference between clever and wise. Munger spent his life cultivating wisdom, reading widely, thinking carefully, building mental models, learning from mistakes, developing character, practicing patience and discipline. And he was suggesting that this kind of development, this old-fashioned work of becoming a better thinker and a better person, remained valuable even in an age of artificial intelligence. Perhaps especially in an age of artificial intelligence, because AI can process information faster than humans. It can identify patterns in vast datasets. It can generate text and images and predictions. But can it be wise? Can it exercise judgment? Can it understand nuance, context, ethics, the second-order consequences of decisions? Munger's answer appeared to be not yet, and maybe not ever. And therefore the work of developing human intelligence, real intelligence, not artificial, remains as important as it's ever been. This was his final gift. Not a prediction about whether AI stocks would crash or soar. Not a forecast about technological progress, but a reminder that wisdom is timeless, that clear thinking is invaluable, that the work of becoming rational and disciplined and thoughtful never becomes obsolete. On November 28, 2023, Charlie Munger died peacefully. His family reported that he remained mentally sharp until the end, engaging, witty, himself. And perhaps it's fitting that he left when he did. Having witnessed the AI mania reach levels that confirmed his suspicions, having delivered his counsel, having lived long enough to see the pattern repeat once more. The question now is whether his message will be heeded, whether investors will remember the lessons of past bubbles, whether the gap between AI's promise and its reality will close peacefully or catastrophically. Munger couldn't answer that question. He could only point to patterns, share what he'd learned, and remind us that intelligence, old-fashioned human intelligence, works pretty well for avoiding standard ways of failing. Closing reflection. So, what do we make of Charlie Munger's parting counsel? Was he right about AI? Will history vindicate his skepticism? The honest answer is, we don't know yet. And that's actually the point. Munger wasn't trying to predict the future. He was trying to think clearly about probabilities, about valuations, about the relationship between price and value. And he concluded that AI in 2023 was overhyped, overvalued, and overconfident. That doesn't mean AI won't be transformational. It might be. It probably will be in some form. But transformation and good investment returns are different things. The internet transformed everything, but most internet stocks at peak valuation were terrible investments. The railroad transformed America, but most railroad stocks eventually became worthless. What Munger understood is that the question isn't whether technology changes the world. It's whether the current price already reflects all that change and then some. And his assessment was that AI stocks had priced in miracles. Decades of perfect execution. Winner take all dynamics. No competition, no regulation, no disappointment. That's a fragile bet. Because reality rarely matches the best-case scenario. Complications arise. Competition emerges, technology shifts, markets evolve, and when valuations are stretched, when there's no margin of safety, when the price requires everything to go perfectly, even mild disappointment can lead to catastrophic losses. So perhaps Munger's parting message wasn't really about AI at all. Perhaps it was about something more fundamental. The danger of certainty during uncertain times. The investors piling into AI stocks in 2023 were certain. Certain AI would transform everything. Certain early investors would be rewarded. Certain this time was different, and Munger, having watched that certainty destroy wealth across generations, was cautioning against it. Not saying AI won't matter, just saying that certainty is dangerous, that crowds are often wrong, that old patterns repeat, that wisdom requires humility. I'm not entitled to have an opinion on this subject unless I can state the arguments against my position better than the people who support it, he once said. I think I'm qualified to speak only when I've reached that state. That intellectual humility, that demand for rigorous thinking, that refusal to embrace easy answers, these were Munger's gifts, and they remain valuable regardless of what happens with AI. Because whether AI proves revolutionary or disappointing, whether the stocks crash or soar, whether Munger was right or wrong in his specific prediction, his framework for thinking remains sound. Avoid standard ways of failing. Stay within your circle of competence. Don't pay premium prices for speculative promises. Understand the psychology of crowds. Recognize when incentives drive behavior. Practice patience. Demand margin of safety. These principles worked for Munger across 70 years of investing, through bubbles and crashes, through revolutionary technologies and failed fads, through manias and panics. And they'll work long after the current AI cycle resolves, whatever form that resolution takes. As you drift off tonight, as these thoughts settle into your subconscious, perhaps the lesson to carry forward is this. Wisdom isn't about knowing the future. It's about thinking clearly in the present. It's about recognizing patterns without being enslaved by them. About learning from history without assuming exact repetition. About staying humble while maintaining conviction. Charlie Munger spent 99 years developing this kind of wisdom, reading constantly, thinking carefully, admitting mistakes, refining his understanding. And in his final year, when the world celebrated artificial intelligence with unbridled enthusiasm, he offered one last reminder. Old-fashioned intelligence works pretty well. Not artificial, not hyped, not revolutionary. Just careful, disciplined, rational thought, applied consistently, over time, with patience and humility. That was his parting counsel, his final gift, his final demonstration of the principles he'd lived by. And whether you're thinking about AI, about investing, or about how to live well, those principles remain as valuable as they've ever been. So sleep well tonight. Let your mind absorb these patterns, these lessons, this wisdom earned through a century of observation. And remember that the work of becoming intelligent, truly, deeply, wisely intelligent, never becomes obsolete. Even in an age of artificial intelligence, perhaps especially then. If you found wisdom in Charlie Munger's parting counsel, if these quiet reflections on thinking clearly resonated with you, consider subscribing to Fall Asleep Smarter. Let your mind rest while it learns. Let your subconscious absorb these timeless patterns and drift off knowing that sometimes the most important message is delivered not with drama, but with the quiet confidence of someone who's seen it all before. Sleep well.